And our first question by email from Michael B. is, what are your experiences about closing a profitable RPM, radioactive profit machine? His question goes on to say, on one hand, I find it better to manage the profitable, in the best scenario also bulletproof, radioactive trade as to start a new one all the time. On the other hand, during the last days, I almost lost the whole hard work profit in 2 positions of the same sector. Me too, AMAT and MU. My fault of sector non-diversification. And of course, somewhere in the blueprint, the full work that describes radioactive trading, read the rule about being profitable at 10 to 15% when one can start thinking about taking profit off of the position. Okay? All right, so first, what is an RPM? As I mentioned, it's a radioactive trade. It's our combination of a stock plus put combination. We look to purchase a put 5 to 6 months out in time. My average is about 7 months, 210 days when I buy a put against a stock to control the risk. It's a limited risk position. We start off with only a risk of maybe 5, 6, or 7% on every trade that we open. And after we make some adjustments, we can actually cancel that risk and have what's called a bulletproof trade, where there's no risk on the position. So here's my current position as it stands on Planet Fitness, which was opened a couple of months ago. It is a bulletproof trade. I'm holding the 30 strike put, but my cost basis into the stock plus the put premium is only about $27.40, $27.60 or so. So I'm guaranteed to make $2.40 no matter what the stock does. As you can see, it's above that, so we're making well more than that at this point. So even if the stock collapsed to 21, this position is bulletproof, a guaranteed profit of 8%. Currently, I could liquidate the position and make a 17% profit after about 90 days. So why am I still in the trade? Okay. To the points of the question, I was asked by Michael, on the one hand, I find it better to manage the profitable, in the best scenario also bulletproof RPMs rather than start a new one. Me too. I've been in Planet Fitness for 90 days. The comment that Michael made earlier about the 10 to 15%, where my goal for a radioactive trade is about 1 to 2% per month. I'll put it at 1.5%. Whether that's related to a 1.5% reduction in risk or generating 1.5% of premium every 30 days, that's my goal for every 25 to 30 days on the position. I still have, it's a February put, I should have explained that, but I still have 75 days to expiration. Now, as you saw, going back one more, I'm holding the 30 put, but the stock's at 31.62. The other day, it was trading at about 32.40, and I was contemplating rolling up to the 35 put to lock in 16, 17%. Okay? Now, I didn't do that, and then, of course, the market pulled back, so it's at 31.62. But this is a February put that still has 75 days remaining to expiration. Okay? But I'm actually waiting to see if there's more upside. There's nothing wrong with closing now. I take 17%, 3 months worth of effort, so it's going to average about a 4.3, 4.4% return per month in the 94, 95 days I've been in the position. But I'm still waiting to see if there's more upside. Now, there's nothing wrong with closing now, but I'm still waiting to see more upside. And if it falls, okay, in the next 15 to 20 days and goes below 30, I'm still guaranteed that 8%. So I've still met my goals for being in the trade for about 4 months, 110, 120 days. Now, back to that 10 or 15% that he talks about when we talk about thinking about the profit on the table, taking the profit off. That's very true. Talk about 1 to 2% per month. We're averaging about a 4% return per month for 3 months on this trade. So why am I not closing it? Well, again, it is the strongest horse in my stable, so to speak. I still think it has strength, even though the market has been hesitant the last 48 to 72 hours or so. But I still think that it has further upside. So I'm leaving it as is, knowing in the next 10 or 15 days, if I hit that mark where I'm in it for about 120 days, it drops below 30 and I'm about at that 8% profit, I'll close it then because I've met my goals and maybe my sentiment has changed. Let's talk about the general rules about closing a radioactive trade, which, by the way, we're going to talk about how that applies to other strategies that came in via email. What are my general rules for closing a radioactive trade? if my goals have been met. So before I even open a RadioActive trade, a married profit position, I have goals in mind of what I'm looking for to make on the position. Okay, I mentioned mine is about 1 to 2% per month. I'm shooting for about 1.5%. Typically, if my put, however much I've been adjusting it, trading it, if I haven't met my goals yet or I still have further upside, when my put reaches 60 days to expiration, that's when I have to decide to either get out of the position or continue to trade it depending on my outlook. Because this is when the time decay kicks in. Those last 60 days is when I start to see that rapid time decay on the position. So I typically want to close a put before I'm within 60 days to expiration of my insurance policy. And if I'm within 60 days and there's no events between now and expiration, meaning there's no ex-dividend coming up and there's no earnings, I will likely close the position for profit or for loss, depending on where I stand. If it's not working out, especially it's been stagnating, I'm not meeting my goals, let me go find something else. Now, that being said, I have several times in this scenario been in with 60 days, but I have earnings coming up. Let's say I only have 50 days to expiration on my put, but earnings are coming up in 12 days and the ex-dividend date is coming up in 14. In this case, I may not close the RPM. I may stay in it to go through earnings with a limited risk and get the dividend. I may also do an income method that will allow me to profit in both directions, a synthetic straddle or synthetic strangle in that scenario, going into earnings in case there's an earnings miss. But again, that depends on where the position stands and if doing that particular income method would take on too much extra risk. Right? When else would we close an RPM? If your sentiment has changed. Okay, so we're in a stock, we're looking good, we've kind of been meeting our goals for the first 30 or 60 days, and then something happens, the stock falls, and now we're looking at a loss where we kind of had a gain where we were meeting our goals. If my sentiment's changed and I don't think the stock will recover, I'll likely close out of the position. Just get out of it. Don't try to overtrade it. Don't try to sit there for 3 or 4 months with nothing going on or the stock continuing to fall. If the event happened and now you're bearish, you think the stock's going to continue down or the sector's going to continue down, I may close the stock and hold on to the put and just continue to try to profit on the downside, or that's when I might use income method number 12. So if my sentiment has changed from bullish to bearish, I'll evaluate income method number 12, or I'll close the stock, leave my put in place. So now I'll have a long put position where my risk or my cost is what I originally paid for the put and any loss I took on the stock at that point, but it's because I feel the stock is going to continue to move down again, assuming I still have more than 60 days to expiration in that particular put option. Now, if the fall occurred and you think the stock's going to stagnate, it's much harder to manage the position. It's much harder to apply income methods. You run the risk of trying to sell a call at a lower strike price well below your put strike, so if the stock recovers, you have a bigger loss now than you would have had you have done nothing or closed out earlier. Okay? So if I feel the stock's going to stagnate, a drop happens, my sentiment hasn't changed, but I don't see a lot of growth left in the next 60 to 90 days, why sit on something and waste the capital for 60 to 90 days? Again, if no dividends or earnings are coming up, no catalyst to move the stock, I'll probably just close that position and move on to something else. Okay? Now this is all included in the exiting an RPM chapter of the blueprint, and that's the guidelines I follow for my personal trades. Like you, Michael, I have the same experience with AMAT. You were bulletproof on your position if memory serves correct. You got into it about a month before I did at a lower price. I got into AMAT around 54.60 with a 55 put out to April, I believe, and the stock had moved up to about 58.60, so I moved my put up to move my risk down from about 6% to 4.7% where I stand right now. So as the stock had moved up, I could have had a 1.4% gain on November 24th. I could have closed it out close to meeting my goals, but I saw further upside. That's why I rolled the put to begin with. Otherwise, I wouldn't have rolled the 55 to the 60 and just liquidated it at that point. But earnings happened. It was up around the 58.60, 58.70. I think at earnings it opened up at 61 and then pulled back, which we talked about before. Michael was kind of depressing that morning. I was hoping it was going to stay above 61. But in any case, here's my position on AMAT now. I have a 4.7% risk. In the last 3 days, the stock has dropped from $57 down to $52 per share where it is right now. But I'm holding an April put that is 140 days out. Now, I could liquidate right now and only take a loss of 2.4%, about half the maximum risk I have on the position. That might be a good play if my sentiment has changed. Okay? But my sentiment hasn't fully changed. I still think it's a strong stock. I don't know how long this hit in the tech sector is going to last, where NASDAQ just dropped those 3 days, and that's essentially what pulled it down. It could settle and start to move back up. It is a strong stock in its sector. Okay? I don't want to risk selling a 52.50, a 53 or 54 call right now to knock that risk down further, because the stock dropped about 3.5 points in 1 day. If there's a recovery, it could go up 3.5 points. I don't want to be stuck holding the 52.50. If the stock jumps up to 55, now I've got to pay another $3 to buy that back, and I've added to my risk instead of lowering it. Okay? I just crossed the ex-dividend date. Haven't received the dividend yet, but I will. And so that'll help lower it. And the next earnings and the next ex-dividend date are coming out in February. And I'm holding the April put. So that'll still be 60 days to expiration. Okay? So in this case, I haven't met my goals. Why am I staying in AMAT that it's dropped from 58 down to 52? Well, set your targets and your goals. I haven't met my goals yet, and my sentiment hasn't changed. I still feel bullish. It was an outside force that pulled it down. Large sector, large industry pullback. That's why it's down. I still think it's a strong stock. As always, when I open any position that has a far out expiration, I'll evaluate it 25 days. So whether I'm doing a diagonal call spread, where I've bought a call that's 90 to 100 to 140 days out in time, at the 25-day mark, I'll reevaluate the entire position. Do I still feel bullish? Do I still feel confident that the calendar call or diagonal call I'm in matches my sentiment for the stock? And if not, I'll make changes as necessary. Now, yes, I like to keep the winners and even the bulletproof trades to milk more out of it. I held Johnson & Johnson a couple years back all the way to the expiration date of the put, selling 2-week out options for the last 3.5 months just to generate an extra 60 or 70 cents every 2 weeks. I couldn't lose, so I figured why not just keep generating the premium? So I did that too. Of course, if Johnson & Johnson had fallen very far below my put strike price, I might not have done that. All right. Why am I not exiting the winner? Well, for Planet, I'm 4 months into the trade. I have met my goals, exceeded my goals, and could liquidate now for 17%. Okay. But even if I do nothing in the next 20 days and the stock falls well below 30 for some kind of market correction, an unforeseen event, guess what? I still made my 8% for being in the trade for 4 months, 2% each month. That met my goals for this strategy. May I regret not closing it out for the 17% profit right now? Sure. Should I have rolled up the put the other day when the stock was at 32.20 or so up to the 60 strike and guaranteed a 15% profit? Perhaps. But I didn't want to take away from the upside profit potential. And right now I'm still higher at 17%, even with the pullback recently, than I was if I'd rolled up to the 60 put and added more costs in the position. Okay? And for the AMAT trade, which is struggling, remember, I'm still only at a loss of 2.4% on the position. Max is 4.7. Right now I could close it for 2.4%, but I can use other adjustments prior to February, before the next events. And if my sentiment does change on the AMAT RPM, I could adjust that as well. Okay? So that's what we're going to look for in that strategy. That's what I look for when exiting an RPM. And I do see there are a lot of questions that have come in. Don't worry, folks. I'm going to get to all those in a minute. I just want to cover 2 more things that came in via email as well, because this also comes into play. The same concepts I just discussed also come into play in other strategy. Paul asks, are there ways to manage long collar positions? Okay, there's many ways to manage long collar positions. If I find an extra copy of my older book, Paul, I'll send it to you. I might have an extra copy of the Protective Options Strategy books that I wrote several years ago with Ernie's. I talk about how I manage the standard collars. I even talk about the radioactive trades. What do I mean by standard collar? Well, standard collars, when you buy a stock, you sell an at or out of the money call for near-term expiration, 1 week, 2 weeks, maybe a month out in time. And you buy a cheaper strike put with the same expiration that is below the stock price. So you've got a bracket around the position. It gives us a profit and loss chart that looks similar to a bull put credit spread or a bull call debit spread. So you have an out-of-the-money call and out-of-the-money put with the same expiration date. So what Paul is asking is he gets into a situation where he finds that the underlying stock has risen significantly before the expiration date of the call. So now stock's above his call strike price. He's risking getting a sign and getting the maximum return. But he would like to roll the calls forward, again, on the winners. Want to keep trading the winners to see if he can get more profit out of it. However, when he gets to that point, the put is too far out of the money and has no premium. So he wants to roll the calls forward to avoid assignment, but he's worried he's not going to get anything out of the put because he wants to roll that too. And he doesn't want to keep the covered call over the weekend without any insurance, okay? And the second case is the opposite. The underlying stock is down, but not to the level of the put strike. You could buy to close the calls for little money, and my puts have good value. However, the call premiums for next week are not very attractive. Should I simply close all the long collar positions at expiration, regardless of whether the underlying stock unchanged or down? All right. My first comment is going right back to the comments we just discussed. When rolling a collar, ask yourself that same first question. Have you met your goals? Okay. You're trading a limited risk strategy where you entered it knowing that you could make maybe 0.5 or 0.6% if you were assigned, and you're risking maybe 0.7 or 0.8% in the maximum case if the stock falls below the put strike price. What you have to do is also develop a trading plan. And what I mean by that is take a look at your last 4 months, 5 months, maybe 1 year of collar trades. If you've only been trading them for 3 or 4 months this way, that's fine too. All right, Paul, so I'd go back and look at that. What I want you to do is evaluate what is your win ratio of the 26 collars you've opened in the last 3 months. How many were winners? How many were losers? Okay, what is your winning ratio? Next step, what is the average return on your winning trades, and what is the average loss on your losing trades? And then what I want you to do is go to RadioActiveTrading.com, go to the trade simulator and plug that in. The reason why I want you to do that is that I trade collars as well, have since about 2002. They represent about 10 to 15% of my total portfolio. I usually go out 3 to 4 weeks. You're actually trading weekly collars. On my collars, my standard collars, not related to the radioactive trades, although they're similar trades, but on my standard collars, Paul, I'm looking to make about, my average is about 2.5% win percentage when I'm right, at a loss of about 4%. It comes out to about 3.8% when I'm wrong. With that ratio, I need to be right about 68% of the time in order to profit long term. Luckily, for the past 15, 16 years, I've had that. I've been right about 71% of the time with my collars. This doesn't include management. I'm just looking at a straight bracket of what are you seeing with your position, so you know how often you have to win. So if your average winning trade with these weekly collars you're doing is 0.6% on the winners and your loss is 0.4 on the losers, you can probably actually be right only half of the time and still profit. However, if it's reversed and your average winner is about 0.4% and your average loss is 0.6%, you're going to need to be in that 68% bracket, 68% or higher tier, I should say, without management in order to profit long term. And if you're not getting that, the management might not help you. Okay? So let's go back to your scenarios. I have no problem with rebracketing the collar. I do that all the time. Okay? If the stock has moved up, I'll move the call and the put up as well. If I did usually again, I do a 3-week out or 4-week out monthly trade with my collar. So if the stock goes above the short call strike price, I'll roll the short call up like a covered call. I may leave the put in place, depending on the premiums I get and what happens to the cost basis. Okay? but you're doing weeklies, so you have to decide what to do. Okay, one thing that you could consider is to roll the call up. In either scenario, roll the call up and don't touch the put, but buy a second put for the next week expiration. So you have two puts technically at that point. This way you don't waste a commission trying to roll the put, but you will spend a commission to buy the other one, and you let that first put just expire worthless. Okay? I don't have a lot of suggestions for you on that, because if you're trading, you're opening collars with 4 days to expiration, you know one of them is quickly going to go to zero. So even if you buy it back, it's going to be cheap. But if you want to keep the collar in place, you've got to add it back in. So one thing you could do again is add the put when it's between the strike prices, add the extra put, let your current call and put expire, maybe sell the call on Monday. Okay, or you could just roll the call, add the extra put, and then let this one expire. You'd have to evaluate what your commission cost would be versus what you're doing now to compare that. But I understand, when the stock moves up, your put's at a 0 bid and a 1 cent ask. You don't even know if you're going to get filled to sell to close your initial put, and then you have to buy to open the next one. You've got to roll the put as well as rolling the call. Okay, so it kind of gets tricky with the weeklies, and by the way, that's why I don't trade collars, the standard collars with weekly options, because I like to get a little bit more bang for my buck, and I still have my goals on the position, and I know annualized return, getting 0.4% a week is better than getting, let's say, 0.9% for 4 weeks out. Okay, no problem. You're absolutely right. But again, I'd rather have the higher premium up front with my standard collar and do a 20 to 30-day trade. That's me personally. I don't do weekly collars because I do find weekly options harder to manage for rolling and for adjusting because the small premiums and trying to force it week by week by week. But again, one suggestion I would have for you is add an extra put. So when you're looking at rolling it, you're fighting to try to sell to close the put, just buy to open an additional put. Let your put that expired today just disappear without rolling it, without paying commissions on it as well, and then move on from there. Okay? Now, I'm going to do this later. We're at 5 o'clock, okay, Eastern time. And I have several questions coming in. I was going to go ahead and jump into other discussions, 2 customers I had who had disastrous positions during this week, and I'll look at that later in the session if we have time. But so many of you have been patient while we discuss our adjustments on exiting an RPM for profit or for not, or for rolling or rebracketing a collar, came in via email. We're just going to jump into your questions now, and I'll get into my other discussion at the end of the presentation if we have time. And of course, if we don't have time, then we'll just go ahead and approach that at a later date. All right. Okay, so first things first. Let me navigate over to the Power Options suite of tools here. Just give me 1 second, folks. Here we go. I'll leave this on the widescreen so it's easier to see. So let me change our screen. Fantastic. Okay. And as I mentioned, let's get to Walter's 3 questions that he came in at the beginning. Question number 1 from Walter on the fly. I have 3 questions. Number 1, the probability above or below percentages that you show on Power Options, is that derived through an independent service? And you can explain, do they mean probability security will reach the strike price at expiration or will touch the strike price at some time? Okay, so whenever you're doing one of our searches or you're on the option chain, I'm just going to go into bull put credit, or you look up an option chain on Power Options for a specific structure and you see all the strikes, you're going to see a field called probability above. Or, of course, if you're in the bear call credit spreads, would be probability below and so forth. All right. So is this derived through an independent service? Well, it's done through a calculator in the system, in the database. It's done through a control. But the probability equation we use on Power Options is a standard probability equation that's used at many other services. It's essentially taking the 1 standard deviation over the 52-week trading range of the stock. And based on that standard deviation, you can apply a bell curve to say what is the likelihood the stock will be trading at or above or below a certain price in the next X amount of days to expiration. In this case, 14 days. we're looking at a bull put here where we're selling a December 15th 120 put and buying a 100 for a net credit of 43 cents. And we saw a 99% probability the stock will be above 120 within the next 14 days based on the past trading range. This is the probability that the stock will be trading at or above this strike price at expiration. Not at any time between now and expiration. That's known as the ever probability or the Monte Carlo. That's not what we're showing. Or the touch, as some people call it. That's not what we're showing. We're showing the probability based on that one standard deviation the stock will be trading at or above this strike price at expiration. Okay. Question number 2. Regardless of the type of option structure, it seems the ability to reasonably determine the direction of the underlying stock price during the option period chosen. What do you guys use in your travels to ascertain where you believe the stock price will go in the relevant future? Is there a fixed period of time and so on and so forth? Okay. So the crux of this question is that whether I'm doing covered calls, naked puts, bull put credit spreads, married puts, buying calls, doing diagonal spreads, I had a conversation with a gentleman yesterday, new investor to options, new investor to options and to power options, and he had many questions about delta, gamma, theta, vega. How do they react to each other? How does one do this? How can one scalp gamma? How can one scalp delta? How could one use delta or gamma in a naked put trade? I had to stop him with his questions, not because I don't like fielding questions, but because to me there are certain strategies that you don't even need to pay attention to the Greeks, honestly. What do I mean by that? To answer your question number 2 directly, Wayne, yes. If I'm in a naked put, I have just as much emphasis as on the stock fundamentals and stock technicals as I do on the premium and the naked yield and the probability on the position. Same with bull put credit spreads. I have a goal for probability, minimum requirement, minimum return I want, and a minimum net credit. But I'm also going to input specific stock fundamentals and technicals because I want to make sure I'm in the right stock in the right position. Okay? So on that search we were just looking at for bull put credits, this is our bull put credit weeklies. And if you see here on the active filters, I'm specifically looking for stocks that are trading above their 20-day moving average, have been at least 3 days above the MACD crossover, don't have earnings between now and expiration. And for other strategies such as covered calls and naked puts, I'll even be looking for stocks that have a positive earnings per share growth, a relative PE ratio, and possibly mid to large cap stocks. Okay? Because those are criteria that I have found work best for that type of strategy. For the naked puts, for example, if we go to the search and I look at the weekly picks of the day that Ernie put together, here's the monthly picks of the day, excuse me, that Ernie put together and tested historically, you see some of the similar there. He used a stock list, but in order to be in the stock list he selected, stocks had to have a certain earnings growth, certain market cap, certain average volume as well. Okay? Now, there are, I apologize folks, in this result there's 83 total results that match the full monthly picks of the day naked put screen. And the first 25, nothing in that criteria is using delta as a screen. We're using positions where we're looking for a good probability, a good range out of the money for the naked put, for example, and other criteria. We're not using delta as a filter at all, but look, without even using delta, the top 20, 25 results are all within a range of 0.22 to 0.33. So that's a pretty good restriction of delta without even using delta as a filter. Okay, so what I'm bringing, why I'm answering that is because you can put in whatever delta you want, and you can screen for delta, you can screen for gamma, and you can screen for theta, but at the end of the day, if you told me that you only wanted to trade positions that offered at least a $1 premium for a naked put that was 30 days out in time and had a delta of less than 0.4, that's not going to help you find stocks. You're still going to have to look for stocks that have neutral to bullish positions, because that delta might match what you were told to trade, and it's offering the dollar premium, and you've got your delta there of 0.4. But if you're trading it on a bearish stock, you're going to lose money. I don't care what your delta, what your gamma, or what your theta is. You're going to lose money. If you structure a trade, structure a criteria based on even just a few criteria that match the sentiment for the trade. You know, if I want bear call credits, I want stocks trading below their 20 or 50-day moving average, and if shown a downtrend, maybe with Bollinger Bands and MACD. And then, of course, I'm going to put in my requirements for probability and others, but just by using those basic criteria, I'll probably see only 35 or 40 results that match my criteria. I've narrowed down the universe of options, okay? And then finally, so I don't predict a price, okay? The only time I might predict a price is if I'm using the long option finder, right? So I'm going to buy a call, I'm going to buy a put, and this tool is a fantastic tool. It says, hey, if I think SPY is going to drop down to $220, and I'm going to put $1,000 into options, and I expect it to fall there by December 14th, okay? I'm trying to pick a price here because what this tool will quickly show me is which options would give me the best bang for the buck if the stock did hit my target price on my target date, okay? And that's what I'm looking for. There we go. Okay, so here we see the put options that would match the return and give me the highest return if the SPY did hit my target. I'm not saying this is a real target, okay? So I don't pick a strike price when I'm selling a covered call, doing a naked put, doing a bull put credit spread. I'm looking for positions that match my stock and option criteria. And your third question is, do you guys rely at all on the Thinkorswim predicted move indicator? No, I don't use Thinkorswim at all. It's a great service. They have great education and fantastic tools and very competitive prices. I don't use anyone's predicted move indicators on specific ranges of options activity and so forth. Why don't you publish the same on your website? Because I don't think it's any more reliable than doing common sense criteria. Okay? I'm not looking to pinpoint a strike price to maximize profit. I'm not looking to say, hey, SPY is at 264.46. How can I make the most money if it goes to 266 right now because some indicator told me based on the options implied volatility of the near-term December 8th and December 15th series combined with a gamma measure, the stock will be trading at 266.03. No, I'm not doing that. I'm saying that if I'm neutral to bullish on SPY, I'm going to look at my criteria for a bull put credit spread. If there's no spreads that match my desired return with the probability I want, the time frame I want on SPY, I'm not opening a position. That's my approach. Okay, I don't fall into indicators. I don't fall into projections or target prices that Goldman Sachs comes out and says that their new target for Planet Fitness is $36 in the next 3 months. Hey, I've already got my position in place. I know my target already. Okay, and if it doesn't hit my target, I'm already profiting by 8% anyway and could have more. Okay, so I don't go that to indicators. We don't publish individual stock indicators or selections because we feel it's better to follow a trading plan with a proper structure for technical fundamental criteria in a strategy and the proper options concepts. Don't look for the covered call that offers a 20% return even if the stock is bullish. You know that means there's too much implied volatility. Something's coming up that could cause the stock to fall 60%. If I'm trading a 2-week out or monthly covered call, I'm looking for common ones that have a return of 2.5 to 4% on quality stocks because that's what's going to be profitable long term. Not the home run trade or the once in a lifetime trade that you think you see and you got lucky once and it worked. Then again, you opened on the same stock. Let's say you bought a stock at 20 and you sold a 22.5 call and the stock moved up to 22 and you actually got an 8% return not being assigned. You said, hey, that's great. The stock's now at 23. I have a cost basis of $14 or $17. Let me sell this 20 call for $5. And then the stock falls to $11.50, which is what happened to XNet this week. Okay? So I don't go for indicators, what someone says is an indicator that was looking at past performance and past earnings, but not applying potentially other targets in there as well. Okay. We look for a trading strategy. We look for a strategy within a strategy, looking for the stocks you'd want to trade for a covered call or a naked put with matching the premium you want to see. Might not always be the sexiest trades, and I can easily use power options to show you covered calls that have higher returns than what would come up in the picks of the day for the weekly or the monthly. But guess what? That strategy long-term over time would lose money. We put these together, and the default searches in each of the strategies we support, the 23 strategies we support, the criteria that you see down here at the bottom in each of these searches are what we would use in our personal accounts if we were going to trade a weekly covered call, a monthly covered call, a dividend covered call, a weekly bull put, and so forth. And they're based on our historical testing and what has worked as well. Okay? All right. Okay, so that's the answer to Wayne's 3 questions, I believe. All right, so let me go back up here in order, okay? Another question that came in, what is better, a straddle swap or a strangle swap? No real way to answer that question. Okay, so what you're asking here is, let me just go to the custom spread tool. I'll take AMAT, for example. And let's say last week I would have opened, when the stock was at 57, let's say I would have opened Straddle at 58. And this would have been $2 for the call and probably $3 for the put at that point. All right, so $5 in. Oh, sorry, folks, the 60 strike. There we go. All right, so now it's in a profitable zone. Now, for straddles or strangles, I'm at this point, and I think, let's say the stock's going to continue in a desired direction. I'm in a straddle right now where I bought a call and a put at the same strike for the same expiration, which gives us that V profit and loss chart. A strangle here would be if I had bought the 60 call, maybe bought the 55 put, or vice versa, depending on how you want to straddle, structure your straddles or your strangles. Okay. Now, to profit further to the downside, what could I do? Well, some investors like to move the whole straddle down, take the profit off the table they have right now, and then buy a cheaper straddle to have lower risk on the position. Now, what is the difference between the two? Well, here we're looking at a straddle which had a risk of 5 points using the same 58 strike. If I bought an out-of-the-money strangle at the same time, might have bought an out-of-the-money 60 call and an out-of-the-money 56 put. So you get that U profit and loss chart. So what does it mean? It means you have lower cost with the strangle, which is further out in time, so you have lower risk. But then your upper and lower break-evens will usually increase. Okay, so you have lower cost, but need a larger move to profit. Now, in either situation, as the stock moves, people will look to roll the profitable leg, maybe down, or take the profit off the table on the winning leg and restructure the entire trade. So which is better, a straddle or a strangle? Well, it comes down to what your profit is. And a straddle swap or a strangle swap, a way to manage an existing position using a straddle or a strangle. It comes down to what is your profit on the position, what are the prices of the new options, okay, and what is the risk inherent in doing it. You're going to lower the risk because you're taking profit off the table, that's true, but you could say, well, the strangle, if now I rolled this down with the stock at 52, if I bought a 50 put and a 54 call, I might have no risk, meaning you might have canceled all of the risk from this point to doing a low-cost strangle, but now further profit, keep in mind, is on a wider break. You need a further move from where you are now. You don't have any risk, that's great, but where's your profit? Whereas if you roll the whole straddle down, you might still have a risk, let's say at the 52 or 51 mark, but then your upper to lower break even, if the stock swings this way or swings this way, would be closer. You'd realize a profit faster even though you have more risk. Whereas potentially with the strangle, you'd have no risk, but you'd still have a wider break-even range. Okay, so managing a straddle to another straddle or to a strangle has its benefits, but it comes down to what you already have in the underlying gain of the initial position, and then going forward against that, what is the market offering you to have either a no-risk straddle or a no-risk strangle, and what will your break-evens be at the same time. Okay, so that's what it comes down to. Let's see here. Okay. Yeah, so the losing side, yeah, if you adjust the losing side on the position, so in this case, the call is losing because the stock has fallen. That's a good point. I mean, there are many ways to do this. I think we had a webinar recently on this, but I'm in the 58 call and the 58 put. What's losing? The call that I paid $2 for. It's probably worth 5 cents now. So if I think the stock's going to recover, I could simply roll this down to the 50 strike call to create a wide strangle. Now, I've already got the profit here, and I might pay another $2 for this. So if it goes back up to 55, I'll now have a profit on my calls, but remember, I'm giving back on the put. When I roll a straddle or strangle, I don't just roll the losing side. I try to take the profit off the winning side too to lower the cost in whatever I'm going to do next. Okay? And you said, how about a butterfly? Why complicate it? Okay. This goes back to what we discussed earlier, Wayne. I'm at the bottom of the questions just to see the comments that came in regards to this. So the stock falls and I look to adjust it and say, what about doing a butterfly now where we adjust the total position by having, I might sell a call up here at 55, buy one at 52, so we have sort of a bull call debit with the extra put in place, and then I might even do a sort of a broken wing or some other combination. Well, does the butterfly match your sentiment for the position now? Ask that first. Don't just manage a straddle or a strangle by selling a couple legs or doing a ratio by adding 2 more legs on the position, okay? Whatever your new structure for the trade is, if you do a butterfly by selling 2 right here at the 50s, make sure this matches your new sentiment for the stock now. Don't roll to a multi-leg position or turn what was just a long buy looking for a swing in one direction or the other to create a butterfly or a condor if the butterfly or condor doesn't match your sentiment for the stock going forward. It could cancel some risk. In a butterfly, you might end up with something like this now that has lower risk to these points. And if you did a broken wing butterfly, of course, you might have a profit here. But if you don't think the stock's going to be here, and it's just going to be in these ranges, it might be a better adjustment to make, as opposed to trying to create a new structure against that straddle or strangle. Okay? What I might do is, if you were considering a butterfly, Wayne, as an adjustment, I'd close both of these, one for a loss, one for a profit, maybe restructure it to where you are here on the position, but you have to make sure. See, this is on AMAT just as an example because we were looking at it earlier. I think this stock is not going to stay at 52. It's going to move one direction or the other. So I would not convert this to a butterfly for any stretch of the imagination because that's not going to help me. Even if I collect a large premium at this time because of volatility, if I'm expecting a swing, that doesn't match my sentiment. If your sentiment is now that you were in this long straddle or long strangle and you had the move that you wanted and you've got a profit, and now you think it's going to stagnate, a butterfly or a condor or repairing to a butterfly or a condor might make sense. But if you're expecting it's going to swing back after the move has happened or even continue down, don't enter a trade where you could turn a winner into a loser because you went into a neutral position to repair it and the stock still had motion one direction or the other. All right. Okay, let's see here. John D. What do you think about the strategy of buying an option ETF position along with a 2-year leap put option and selling monthly calls against it? Example, GDX. It gets tricky, okay? Now, earlier I had mentioned the married put, and we had talked about that, how you could open a position that had single-digit risks. And a lot of investors look at the married put position, and you're asking the right questions, say, why would you ever buy the stock? We trade in options because we like options. and we want to do something else and take advantage of leverage. So instead of doing a married put, why don't you just buy a slightly in the money 21 call at 350 instead of buying shares of stock? And then still buy the 2-year out 24 put you're expecting to buy on the position. So now instead of having $23 invested, you've only got $6, or $29, you've only got $6. So you create an in-the-money long strangle position. Oops, not with 100 contracts you don't. We do 1 and 1. All right. So now I've got an investment, okay, $700, $690, which represents, now here's the trick. Here's where the lie of leverage kicks in. If I open a married put and bought the stock at $22.49 and bought the 24 put for $353, I'm only going to have a maximum risk of about $150, $160. All right, $25, $70, yeah, $180, $190, which would only represent maybe 8% or 9% for a 413-day insurance policy. Remember, the max risk that you're doing when you attempt this in-the-money long strangle is going to represent 50 to 60% of your capital. Okay, so you are at a 50% risk ratio. Now, your max risk is $390. If the stock is between these two strike prices, you're going to try to eventually lower that by selling calls against it. This is very dangerous unless you think you're in a strong neutral position. Why? Your cost basis is $690 out of pocket. Max risk is only $390. But now, to sell a call against it, stock at $22.49, let's do a monthly, 28 days, December 29th. Go a little bit out of them. All right, we'll go to the $22.50 call. How about that? It's right at the money, but it's 40 cents. So there's not a lot of premium here. All right. Does this match your sentiment for the stock? Why are you getting into GDX? Well, when you opened it, you're trying to mimic, obviously, a married put position with keeping a low risk, but you've actually doubled the risk, and you're risking 56% of what you would have with a standard married put position. By selling the call, but you do this because you're expecting movement one direction or the other over a period of time. And as we saw here, you say, well, the $22.50, Mike, that's too much at the money. I wouldn't sell that one. Well, you set a 1 month out call against it. Okay, so we go back to December 29th. Do you want to go to the 24 that's only at 5 cents, 6 cents? You want to stick at the 23, which is only 21 cents. There's not a lot of premium there. Okay, so you generate 21 cents of premium over the next, every 30 days for the next 413 days, and you could go out to 2020, but you're just going to increase costs. But again, even in that scenario, I'll go to the 23 strike. Let's go ahead and sell that 23 strike we were looking at for 21 cents instead. Now this little bubble here, sure, if it falls, you've got no risk, but if it moves up, you're risking more than you originally anticipated because it's a cost. You're obligating yourself to deliver shares of stock well below the total cost basis of what you could get into the position. You get in at 21 and you sell it at 23, so you make 2. All the while, this is losing value, and your cost basis was $669. Okay, so you still have all this risk to the downside. And then you say, okay, well, why don't I just sell a put then to hedge that also? Well, see, now we're complicating things in the wrong direction. I sell an out-of-the-money 22 put. You've essentially created a double diagonal, which is a reliable trade. But where did we start? Okay, you started long-term with this structure, looking for movement one direction or the other, or trying to mimic a married put because you're neutral to bullish, or bullish because you think it's going to move up, but you wanted to use leverage with the in-the-money long strangle. Now you've created a position which is the exact opposite of the sentiment you originally anticipated. This comes down to the rule of don't feel pressure to generate premium against your trade just because premium is there if it goes against your original sentiment for the position. Ask yourself first, why are you opening And I'm not saying there's anything wrong with this initial approach or other approaches to manage it, but ask yourself this question first. Why are you planning on opening this structure? Are you trying to mimic a married put position by using leverage so that you don't have to buy the stock at $22.49 and buy the 24 put? So you want to buy the 21 call, which doubles the monetary risk, risks 60 to 50% of your capital, which if you take one loss, you need 100% gain on your next position to get back to break even. Now sure, you've got 413 days here, so you probably would never take that maximum risk, but that's just keeping in mind the structure and the lie of leverage, okay? The minute you sell a call against this for too small of a premium or at too low of a strike price, we saw what happened. If the stock moves up, you've got to scramble now to buy back that call, or you're taking the risk of getting locked into a loss very quickly. Another disadvantage of this is look at the break-evens. Yes, it's at expiration, 413 days away, or 777, it'd be higher, but it's a 5-point movement one direction or the other before you start to get to break even. Even at the halfway point on 627, it's pretty close to those same numbers, 1709, 2791. So that's a large movement to be expected. Now, if I take this out, I take your call out and I just buy the 100 shares right now as a married put, okay, my risk is 7.4%. My upper break-even's at 25.92, not 27. And if I sold a quick call right now, and I would go out to December 29th, I wouldn't sell the 22.5, but let's go ahead and sell the 23. It's not going to look great. But again, I feel this is a slightly better structure. Yeah, I could still lose to the downside, lose 10.5% because I structured it wrong. That's why I would never do this. But again, I think I like this profit and loss chart a little bit more than what we saw with selling the call, trying to force a monthly selling call against a 1-year or 2-year out in the money strangle on GDX or on any structure. There are risks with doing an in-the-money long strangle as opposed to a married put. It takes a lot longer for profit to be realized on those positions as well. And doing the in-the-money strangle hurts you. Yeah, Sam says it's got no premium, okay? And the stock also has no expiration date, which is one of the benefits of the married puts. You don't follow along with that, okay? Yeah, so John, and going back to that with this, I would buy the ETF outright. I would do this as a married put, even though it doesn't profit in both ways. But again, following Sam's rule, not Sam's rule, but Sam's comment, and the other ones that came in, GDX is tough to trade, okay? At the same time, I'm going to own the ETF instead of using the leverage, and it doesn't have an expiration date, but honestly, if I'm opening a married put, I'm going to look for a more bullish stock, something I feel more bullish on, as this is more difficult to trade, okay? So that would be my approach into the position, okay? So let's see here. Let me go back to the top. I still got about 4 more questions to go through and 5 more comments. All right, so this one is from Chris L. Chris L says, if a bear call went wrong, both legs are in the money, then is it better to wait until expiration to let assignment and exercise occur, or to close the spread out? I believe the first one is better, but I don't know for sure. And you're going to hate me for this answer, Chris, but the answer is I don't know for sure either. Okay? It depends on the scenario. Sorry, let me think of a decent... okay, we'll do it this way. Okay, I'm going to use the XNet stock that's been all over the place. And it's at $15.43 right now, but it had dropped to $12 the other day. So let's say that I had done a 12.50-15 bear call spread the other day when it was down at 12, because I thought it was just going to stream down bearish into single digits after it dropped from 23 to 18, 18 to 14, and 14 down to 12. So let's say we sold that 12.50 call for $1.50, and we bought the 15 for 85 cents. All right, so we were originally looking at a 65-cent profit. I should up this. I'm going to up this to 105. I'm sorry. Sorry about that. There we go. Bear call credit spread. 45-cent net credit on a 250 strike difference. Maximum risk of 205. the difference in the strike prices, minus our net credit. Potential max return of 22%. Stock has gone against us and is now trading above both calls, just above both calls, but in this case, above both calls. And I had selected December. This only offers standard, so we still have 15 days to go to expiration. So number one, Chris, I'm going to say it depends on how much time you have to expiration. If this was a weekly bear call, meaning I had sold it for today, and in the last 2 days the stock had blown above both strike prices, there's probably no difference, 2 or 3 cents difference, between closing it Thursday or Friday before expiration today, or closing it earlier today or closing it yesterday. I'd probably still be at close to that max loss of 205, 203, 197, somewhere in that range, right? Because all the time value is out of the position. On this particular trade, now that the stock has moved against me, it dropped down to 12, so, and then jumped back up to 15, and now I'm at a full loss. First thing I'm going to do, this only offers standard expirations, but what is my liquidation right now? All right, let's take the base points, okay, the midpoints, excuse me. So I'd have to buy to close my one call at 365, and we could sell to close the 15 for probably about 220. Yeah, I'll say 220. Okay, so my maximum loss here, sell to close at 365, buy to close at 225. Yeah, we'll call it 225. So I'm at a debit now of 140. Now, in this case, I may be tempted just to close it. Why? Because I still have time. There's still time value remaining on those positions, so I can get out for only a loss. I close it for a debit of 140. So this is going to be closed at 365, buy to close at 365, sell to close at 225. So we pay a debit of $1.40 to close the position, but we keep our 45 cents. Okay, so this is only going to be a loss of 95 cents. I may just close this now and just take the loss, rather than risk taking the full 205, which hasn't been achieved yet. All right. Now, let's say we are close to maximum loss. Two schools of thought here. So let's say if I did close it, I'm at a loss right now of $2 if I liquidate both legs, whether I have 1 week left, whether I have 2 weeks left, whatever it is. But my loss is $2, pretty much at 90% of what I expected to make. Now, yes, if I have 2 weeks left or so, considering I'm already at the maximum loss in the position, and I would have structured this trade with the appropriate number of contracts for my portfolio, where if I did suffer the full loss of 205, this would have only represented maybe 3 to 5%, not 35, 3 to 5% of my total portfolio value. Right? So I could stomach this one loss and not have it hurt too much. All right? But in any case, here we are. So I'm at a 95, 96% of what I expected to lose. Not expected, but 95% of the maximum loss. Yeah, maybe I do just leave this open. Because maybe in the next 7 days or 8 days, if it starts pulling back again, you know, it suddenly fell to 12, then pulled back up to 15, moved up a little bit more. So maybe next week, if it's a little weak, comes back down to $14.50, $14, I may see better management techniques. So I'm already at 95% loss. Why not hold it and see what happens next, okay? You could probably do other management techniques on the position. As simple as, you know, you could be able to maybe to roll this out another month to January, have another bear call spread at higher strikes, which would have less than half of the return, maybe only 7% return, but you'd be at maybe the 1750 or so strike. That might be a possibility. There may be an opportunity here to do the pendulum adjustment, but I doubt it. That's where you'd sell to close the long call, for a profit, and then buy a deeper in the money 10 strike call. So with one move, you've converted this to a bull call debit spread where now if the stock stays above 1250, you'd make a profit. I can tell you right now, I don't think it's going to work in this case, even though there is time to expiration, just because the cost of that $10 call is going to be too expensive. But when the pendulum adjustment, I'm going to sell the long, and I'm going to buy a deeper in the money. So let's sell our 15 at midpoint and buy a 10. I'm leaving the 1250 open. Drat. Okay, well see now though, it's at a loss of only 3.5% or $18. I'm now in a bull call debit spread that yes is guaranteed to lose, but if the stock stays above 1250 because it's changed direction, I'm only going to lose $18 or 3.5%, as opposed to, what were we at, about 90 cents loss on it right now if we liquidated, or risking the 205. Problem with this, the same problem with any management technique when you change structure, is what happens if it does what we just said and it drops back down to 14, well you're still fine, or 13, but if it drops to 11 or it drops to 10, now you're losing on this position, full 268, higher than the initial maximum risk on the trade, where your bear call would have remained profitable at this point. So they take the good with the bad. There are 6 or 7 ways we discuss to manage a position, a credit spread. So if you go to our free webinars section, I'll send everyone the link right now. I still got a couple other questions to go through, but I'm just doing this here for Chris. powerup.com, webinars.asp. All right, so if you go to that page, that's our public webinars page, click on option strategies. There's a webinar here on managing your spread positions, our 7 ways to manage credit or debit spreads. For your question specifically, Chris, scrolling down. No, it's in here somewhere. Oh, I thought I did a separate one. I do apologize. I thought there was one in here. Oh, here it is. I'm sorry. 7/30/2016, managing your bear call spread. So we look at this one just as the 7 ways and the trigger points we would look at to manage a bear call credit spread strategy as well. So you might want to check that out this weekend. That link I sent you, powerup.com/webinars.asp, is a public page. You can access it at any time. Again, click on the Option Strategies tab and scroll down here to July 6th, was it? 2016? Oh, July 30th, managing your bear call spread. You get some more insights there on ways that you could manage it. Is it best to leave it open? Is it best to close it? Or is it best to move on? Okay, so that'll give you some further insight as well. Okay. Oh, Wayne had another comment there. Sam says, look at oil rather than gold, going back to our other discussion. Wayne mentioned common reverse double in-the-money credit spreads in SPX. No, not me. Okay, let me show you what that is real quick. I had a customer call me about this. I don't think it was you, Wayne. I think it was a different customer I had who asked me about these double in-the-money credit spreads and something else that's taught by a man named Bubba. You've probably all seen Bubba's emails coming out there. He teaches a strategy that incorporates an in-the-money credit spread and an in-the-money debit spread, and just not a fan of it. And the reason why is I believe the structure the gentleman presented to me that was taught by Bubba, I always forget his last name, great educator, he's got some great ideas, don't get me wrong, but the structure of the trade made me really nervous for people that didn't know what they were doing. And I'm not saying, Wayne, you don't know what you're doing. That's not what I'm implying at all. During this conversation with the customer, he mentioned that there's a trade out there that's taught where you'd sell an in-the-money bull put spread. So I'm going to sell the in-the-money 265 and buy a 267 bull put credit spread on SPY. And at the same time, I'm going to do an in-the-money, not an out-of-the-money. I'm going to do an in-the-money bear call spread where I'm going to sell the 261 and buy the 263. Okay? I am not a fan of this at all. So what do? We get a credit of 284. We sort of create an iron condor position, but they're within the money calls and in the money puts. Why don't I like this? Because the trick is you can be assigned at any time. So you might be assigned on the bull put side because the stock's at 264. Someone might want to exercise this put, which means you end up buying shares of stock, shares of SPY at 265. Depending on your broker, there's no guarantee that they're automatically going to exercise your 267 put to close this out for a profit, or the difference, the loss in this case, of $2. There's no guarantee. So now all of a sudden, oh, well, Wayne says, yeah, but you do it on SPX, so it's cash settled. That's true too. And it's European. That's true too. But it would work maybe on the indexes, but it's just an iron condor. Again, why complicate it? Why not do the opposite? I mean, is the premium really that much better? Why not just sell the 261 put, I'm sorry, sell the 263 put and buy the 261, and sell the 265 call and buy the 267 as a true iron condor? Why make it in the money? Is it giving you that much better premium? Most of the times I've compared them, they're about the same. You know, I could do the iron condor right now and probably get a credit of close to $1.16, $1.15 being out of the money. Why risk any kind of early assignment doing it this way? Unless you can really get filled at a better price. It's just another way to do an iron condor is really what it comes down to. Is the in the money giving you that much better premium? I don't know. In some cases it might. I agree. If you can get filled at the midpoint, it is. But this is just a different way to do an iron condor, similar to where the out of the money strangle structure that we looked at earlier. If I just bought a out of the money, let me just do this. So I'm going to buy the in the money call and the in the money put. I'm going to take out my short options. So here's a strangle on SPY. It's an in the money strangle though, because I'm buying the in the money 267 put and the in the money 261 call. My max risk is 286. What is my upper and lower break even? 258.14 to 269.86. All right, let's reverse this. Let's do a different strangle. Oh shoot, what expiration was that? I'm sorry. December 20th. Okay, great. I took a weird expiration. I'm sorry. But December 20th expiration, 19 days out. What if I buy the 261 put and the 265 call? Okay, so let's go ahead and submit that. Now it didn't show up as well, but the cost, in this case, the risk is 322. I hope those were the same strikes I had. It was the 265 and the 260. Let me go back just to make sure I had the right ones. I'm sorry, folks. Let's see. So that was the 267. Okay, I'm sorry. Okay, so I need the 267 call. That's why it didn't look right. Now the out of the money 267 call, out of the money 261 put, buying the out of the money strangle, risk of 233 instead of 286. Okay, so why is that important? Well, because now, let me do the iron condor. And we sell the 263 put, we sell the 265 call. Here's our out of the money iron condor with a max profit of 149. Yeah, that's right. I'm sorry. Yeah, that's right. So the max profit of 149, a max risk of only 51. I think that looks a little bit better than the in the money. Oh, sorry. There we go. I think I got the strikes wrong. Okay. Yeah. In any case, I think that looked a little bit better. So they're parity trades. Remember when you do that, when you compare an in the money and out of the money strangle, or an in the money or out of in the money iron condor or out of the money iron condor as well, you got a parity trade. So you want to compare the risk and reward. But remember, anytime you try to convert that iron condor, which is usually done out of the money, which we're not looking at right now, but when you do that out of the money iron condor, you're not risking early assignment unless the stock falls below the short put strike or above the short call strike. Okay? Whereas when you do the in the money, you might be assigned early at any time, and there's no guarantee your broker would close it out automatically. Okay? All right. All right. David H. been very patient. He says, I came in late. Well, we're just getting to you late anyway, and I apologize for that. So will you discuss calendar calls, including selling additional calls as the short-term calls expire? Will the position analysis tool work? Yes. The position analysis will show you positions for diagonal spreads, show you potential rollout opportunities for diagonal or horizontal spreads. Okay? typical calendar call that I would do is going to come directly from the search probably. I set up these criteria to usually match what I do with a couple changes. So I may, I'll use leaps in this case, but what I'm going to limit is the out of the money range. I don't want my short call to be more than 5% out of the money to get good bang for the buck. I'm going to keep the return there. And I probably don't want to go more than 15% in the money in general. Let's take Nike. That's a good one. No, that's not far enough in the money for me. But okay, let's take a look at Nike here. Here's one with a 62.5 January call, 49 days out against a 413 January as well. Okay. Now, I'm just going to go to the profit and loss chart, David, but I know you're looking at something else. So first thing that has to match, which is I have the criteria set up, is I might do shorter term. You're right. We'll take a look at that in a moment. So I'm selling nearer term, mid-December, maybe weeklies against this leap option here. But I always make sure that my debit to enter the position is less than the difference in strike prices. In this case, it's not. It's very strange. It shouldn't have appeared. The reason why, I'm at a 57.50 call and a 62.50 call for $1.09, so we have a debit of 636. The reason why I always want the debit to be less than the difference in strike prices is if the stock suddenly gaps up and goes up to 64 or 65, and I get assigned early, and my broker does exercise the long to deliver the short, I only get $5 back. That's a guaranteed loss of 136. It's the Black-Scholes value of this long option, which is showing the profit at the short term of 232, because it's going to retain most of its value. But if I face early assignment and only get $5 back, this is a losing trade. I don't want that. So I'm going to have to go back here. Oh, sorry, folks. I need this to be less than 1. My debit to strike difference ratio needs to be less than 1 in order for this to work. Okay, so there's the Nike I want. Now, going deeper in the money to the 52.5. Okay. So now I'll get to your question, David. Let me go to the profit and loss chart. Now I have a debit I want of 946 with a 10-point spread. So even if I get assigned early from an unexpected event, I'm still going to get $10 back, profit of 54 cents. Not a lot, but I'm not opening a position unless I have this for my diagonal spreads. Net debit, less than the difference in strike prices, and that's usually set up there on the default screens. Now let's say you get closer in. You want to trade some weeklies. And what do we know about the weeklies? You're going to get less money, so you're going to have to be closer to the stock price to get any reasonable premium. So let's sell the 1 week out 60 call. All right, so here's my diagonal spread. Not great, wouldn't do it. You probably wouldn't either, but it's a weekly shorter term. Now, your question, selling additional calls as the short-term calls expire. No, I never put myself in that potential position. Okay, as I got to expiration, if the stock's at 59.88, I'm buying to close this call and rolling to a December 15th or a December 22nd 15. I'm not going to leave myself open for any chance in the last half hour or so that I have 2 short calls at 60 and the stock moves up to 60.50, $60.20, where I'd get assigned on one and they'd buy this one, right? So what am I saying here is that within 30 minutes to expiration, I didn't buy to close this call, and I sold an additional 15 December 60 call for another 59 cents. Okay, next Friday. We're going in the future here. And, okay, so 30 minutes left in market. Stock's at 59.88. I sell an additional call, so I've got 1 naked call at 59 cents profit and 1 diagonal spread. And in the last 10 minutes, it's still at 59.90 or so. And then at the very end, at 5 minutes, it's at 59.90, looking great. And then the last minute, it goes up to 60.20. Okay, and I go in to close it, but the market's gone. I can't close it. So I might be assigned on this 60 call for December 1st or December 8th. We're a week in the future. And my broker may decide, you know what? We want to exercise this long to deliver this short. Okay, so now they buy shares of stock from me at 52.50 to sell at 60. I'm out of my diagonal, and I'm sitting in this naked call. And over the weekend, the stock goes up to 67 for some unknown event, or the market as a whole gaps up and it's at 63. I've wiped out any gain I would have had in this scenario. Roll the call. Don't do a ratio in this situation. No matter how sure you are of this expiring worthless, just roll the call. Pay the 1 cent, 2 cents, or 3 cents to buy to close this call and roll it to the next week rather than having the risk of 2 naked calls open. Now, of course, if the stock was at 54 for whatever reason, sure, try it. But remember, your broker's going to see that as a naked call. It's not covered by anything at this point until that one expires. Okay? All right. Let's see here. Kyle. But yes, I'm sorry. In addition to that, if you're tracking the positions in the portfolio, whether it's a covered call, a naked put, here's that one on XNet with the stock bought at 23.50 and sold the December 20 call for 5.10, and now the stock's at 15.43. But as you go in a covered call or naked put to position actions and then position analysis, you see a breakdown of your current trade, kind of ugly. But then you'll see potential rollout opportunities. I could roll actually this one out to March. It's 180 days out, 105 days out, but I could take a 20% loss to a potential 10% gain rolling out to the 17.5 call for 105 days. I would do other management on this covered call with the stock down about 40%, and I'm looking at a loss of 21%. There's different ways to manage it, but this one does show you 2 ways that you could potentially roll to a profit on XNet, even though the stock is down from $23 to $15.43. 8 points, 20, close to 40% from where you got into it. Okay. But yes, for a calendar spread, you'll see this as well. Okay. Kyle, I don't know if I'm going to be able, I'm going to try to answer your question. It's not that it's it's got a lot of different parts to it, and we're almost already at 6 o'clock. But all right, you said question from perspective of PM account on weeklies. You could get Facebook 7-day put about $8 in the money for as low as 33 cents. And you're using the other ones, the ratio ones, or the PM ones. Okay. Is there a reason not to play the FANG stocks as low-risk, week-long, more speculative plays? If you're wrong, you're out 330, but given how much they can jump, you have a chance for a nice and quick profit. Portfolio margin allows you to take the stock position without the margining the whole cost of the stock. My best answer is to run your own risk-reward scenarios. You're right. Those different types of securities there's different types of options, the 1/10 options even, and so forth. And looking at FANG and all, does give you the potential for extra leverage. But how often, you still have to evaluate it. You said that it would only cost you $330, but the profit would be nice. Well, yeah, if it has the move, but that's the same with any call option. Lower risk, to get a better profit. And if it's 330 instead of 3,330 for a profit of 1,800 or a profit of 18,000 comparatively, which gives you the best bang for the buck? You have to decide that on your own. That's not something I can answer to you. If you want to put in less leverage and use that kind of margining and use those kind of 1/10 options and so forth, that's great. But at the end of the day, you can say you can still make a nice profit with only risking 330. That's right. But what is your win-loss ratio? Over time, are your gains going to be enough? If you're only right 50 to 60% of the time, are your gains going to be enough to offset the losers? Likely not. Okay, with any long call structure, whether it's on the 1/10 options, whether it's the standard options, whether you're trading SPX or SPY, you're going to need to be right about 63, 64, 65% of the time on long calls, because remember, there are going to be times when you lose 100% of what you invested in a long call. Your timing's just going to be wrong. It's nothing against you personally, but your timing's just going to be wrong. The market's going to have a sell-off you didn't expect, and before you know it, your option goes to zero. And if I bought a 260 call on SPY right now, if there's a swing in the middle of the week and it drops down to 255, my option might only be worth 3 cents if it expires on December 8th. That's a possibility. I have to accept that. Are there times when you'd have a move in the different direction with weekly options or with margined options and you could see a 200, 150% gain on the call? Absolutely. But you're not going to see that every time. More often than not, you're probably going to see 20 or 30% gains from your investment, even only at 33 cents or $330. And you're going to see losses of 40 or 50%. Occasionally you'll have 150% gain and occasionally you'll have a 100% loss. That's just the nature of the timing and the nature of the market. Okay, it's not always going to be the last 18 months where it's gone lower left to upper right. And if you keep in mind, over the last 4 months, once a month over the last 4 months, that happened in August, it happened in September, it happened in October, it's happened twice in November, SPY and NDX have dropped 1.1 or 1.2% in the morning sell-off. It's happened 4 times. It was on August 10th, it was on September 9th, it was in October 12th, and then it happened early in November, and then it just happened the other day. Okay, so for a weekly call, that is devastating. You were, 1%, 26 points, right? Okay, so sorry about that. $2.60 on SPY, 1%, 1.5%, 310 or so. But look, the stocks at SPY is at 264, right? I buy a slightly in the money. Let's just do it. Let me go to custom spreads. I'm sorry. Let's just take a look here. SPY. About December 8th. I'm not going to use the Monday or Wednesday. I'm not getting into that. Not touching Mondays or Wednesdays. I'm just going to stick standard Friday. All right, so 263 call. Let's call it a little under 260. We're just going to buy 1 contract. All right, so the stock's at 264. A $2.60 drop. Let's call it 264.50. So, okay, a 250 drop. A little less than that 1% would put us down to 262 even on Monday. We paid $258 for this call. Calling it 262 even on Monday. Yep, the 4th. Expected value would be $67. Down 100. We've lost $190 of the 257 we invested. That's 66%, 68% on the position. Okay. No guarantee that it's going to, okay, it comes back up to 264 by Friday, the 8th. Well, guess what? You're at a huge loss there. You're over a 50% loss on your position. Okay? Stock only dropped 46 cents from where you started. And even if you're using margin, you can say you're losing less monetarily, and you're right, but percentage-wise is the name of the game. Remember, if I take a 50% loss, so I had $257 to invest, I get out with 157, okay, so it's not a 50% loss. Let's say it's a 33% loss. What do I need? I only have $100 left. What do I need to get back to break even? I need 150% gain on my next trade to get back to that $250 I invested on the initial position. That's the lie of leverage. Whether you're using smaller amounts, whether you're using 1/10 options, regular standard options, SPX options, or SPY, the slippery slope of the lie of leverage will kill you long term. Okay, so you've got to be careful. You've got to make sure that whatever you're investing doesn't represent too much of your portfolio. Because we just saw here, even if the stock only drops 50 cents, you've taken a significant loss on the trade, right? Over a 50% loss, I'm sorry, it's over a 50% loss, which means you're going to need over a 100% gain on your next trade to get back to break even. All right, so that's the risk. Yeah, and that's the gamble. Sometimes the gamble works, Sam says, and sometimes it doesn't. And I think that was actually from an earlier comment, but it still goes here. And Sam also says when you look at the stocks will tend to fall quickly and suddenly, and then they take longer to get back up. And Sam's like me, he'll tend to do a debit spread or a credit spread to go forward on the position as well. And you know, that's the idea there, is the risk with just buying calls. Kyle, I'm sorry, you sent in a question. You said, what about me? I thought I had answered your question. If you had another question, Kyle, in your list there, I thought I got through all of it. I'm not sure. But if I missed a comment that you had made or part of your question, send it to me. We still got a couple minutes left. Sam's been emailing this week. He had some good trades there with SQ, Roku. He said your son was in Roku. That was a good one there. Verizon, you've been doing really well on as well. And something, what was the other one you emailed me about? That strange one I hadn't seen before. I can't remember that one. Okay, all right. All right, let's see here. Okay. All right. Oh, okay. Kyle, I'm sorry. Kyle actually left. I'm sorry. Kyle actually left. He wanted to talk actually also about a different structure of using a short-term married put with buying the weekly put out for only 33 cents instead of investing in the 7 to 8 month out. Well, yeah, I'll have to talk to Kyle about that because it's the cost there as well. The annualized cost is higher even if you're only paying 33 cents than buying the one further out. That was my fault. We did cover the other discussion as well. All right. Last question real quick. We are after 6 o'clock here. Rajiv says, can you check the chart of UGAZ and DJAZ? Yeah, I don't really comment on individual stocks with these presentations. Okay. Let's see. So you're looking at natural gas here. DGAZ. Oh, okay. Let me go back. Yeah, if they're, I'm sorry, if it's not really an optionable stock or an optional position, I'm not really going to comment on it. But let's go. I'll take a look at the chart real quick. But yeah, my discussions here are always just dedicated towards option structures, options trades, and so forth. So let me just go to the chart here for AMAT real quick. I'm sorry. Let's just change it. Throw in some of my indicators for monthly here. It doesn't really matter. I mean, everything's depressed, but I don't know if that's gonna give us what we want here. Yeah, see, to me, this one, what I'd be looking for here is if it crossed over, and it didn't cross over. It touched and then pulled back down. So there hasn't been a crossover verification down below there. Tried to break above the 20-day, couldn't, and came back down. And this is the triple. What are we here? 3 times long. Okay, so this is the 3 times bull. DJAZ must be the 3 times short. Let me just do it. This stupid mic. I'm going to go over here real quick, folks. Sorry about that. Yeah. So everything has been condensing. Same exact chart. You know, I don't know. See, it tried to do it here too, and it broke above. And then this one here, it broke above, but it looks like it's pulling back down. Had a crossover here on the MACD, and then had a negative one. I don't know if it's had a positive crossover that stayed there yet. Yeah, I can't really comment on the individual stock positions, especially ones that don't have options, it looks like, related to them, because my forte is the option structure and the option series. All right. So, all right, so there we go. Oh, Sam, that's awesome. Sorry, Sam says that, I think he wrote this earlier, but it says, yeah, be happy, relax, spend some time with the family, eat a very nice Thanksgiving. And so once in a while he went to the from his Subway restaurant. Okay, he was feeding the poor, giving food out free from my Subway restaurant. Well, that's fantastic, Sam. I'm glad to hear that. That's great that you're taking the time and taking everything, taking out of your own restaurant there to feed those in need at a time where everyone should have some good feelings and some warm feelings. So I appreciate that from everyone else. So that's great to hear. Well, again, ladies and gentlemen, I guess that's going to wrap it up for us today, just after 6 o'clock Eastern Time here. And so I think we've got through all the questions, although I kind of answered part of Kyle's question, but I think I got the rest of it wrong there as well. So I just want to remind everyone, of course, here we go. For those of you that haven't yet, remember, just go to poweropt.com, put in your name and email address. You can have access to that 14-day free trial to test the tools we saw today, as well as other tools we didn't get a chance to look at, free for 14 days, no monetary requirement or credit card needed. And of course, our subscription levels after that start at the $40 per month range for the end-of-day data service. But we do also offer a delayed service at $60 per month and a real-time service as well. We'll have some more information for you next week on some of our other upcoming events as we wrap up 2017 going into the December month. But remember, you can send me an email at any time to support@poweropt.com or support@radioactivetrading.com as well. You can also call us during market hours at 302-992-7971. And remember, check out that webinars page, poweropt.com/webinars.asp. You can also check us out on YouTube, and the trial members and subscribers, you can always schedule a coaching session as well, where Ernie and I will spend 35, 45, 50 minutes with you on the phone to talk about the tools on the site, the various option strategies, and our insights as well. Sorry, I did record today's webinar. It will be posted on Monday. I'll let everyone know when it's available, and we go through all the structures. I might even make some additional adjustments to the discussion today as well. Some things I missed and some things I might have misspoken, but we'll see this. You'll have this access to this on Monday.